It's March 25th, roughly about 5:45 p.m. What I'm going to do is I'm going to share with you just a slight or short analysis on the various asset classes of unit trusts and how they perform over the past 1 month. The markets have actually continued to rebound a bit more, so it gives us a bit of an opportunity to look back now in what I call very historical past 1 month, whereby markets have fallen very sharply. So let's have a look at what did well and what didn't do that well. People have asked me also, last 1 month there wasn't really any place to go to hide from the volatility and the sell-off, but we'll see, and actually there were certain asset classes which still remain in positive territory despite the majority of them were in the red. We won't name the funds in this assessment, so do please approach your financial advisor to find out more about the funds if you need to know more about them. The data is sourced from a website called fundsupermart.com.sg. You can go there, you can actually look at all the funds available and also do some charting, which I will actually utilize quite extensively in this presentation. Of course, the month I've used 1 month data because the past 1 month has been quite historical. Okay, and mind you, I don't cover all regions. We'll just do the major regions and so on. So in terms of the most general big picture kind of assessment, the equity markets in terms of the 3 main regions, S&P 500, the European Stock 600, MSCI emerging markets, and of course the local STI index, over the past 1 month up to March 23rd had fallen double digits, almost average about 28-29% in some cases. So the decline in such a short period of time is really one of the biggest declines historically. So we are really in a very historical moment, so to say. If we narrow down to the US itself, what I've done is this is the S&P 500. I've also taken what I consider to be some of the best performing and worst performing funds. You must understand that these funds sometimes they don't have the same mandate as following the S&P 500. I'll give you an example. The fund could be focused on large cap quality stocks. Some of these could actually be focused on small caps. So for example, some of the worst performing US funds, they were actually the small cap funds, and this is one of them, which went down about 36%. This one, which is down only 22%, which is slightly better than the index, is focused on large cap stocks. So it's really the better quality stocks in other words. So that's why it actually outperformed the index a bit more. In Europe, we will see the same thing. So you see a bunch of European-centric unit trusts underperforming the index, and of course you may see some outperforming the index, basically of different types again, maybe small caps, better quality, dividend paying, and all these things. Okay. Emerging markets, the same thing. So we have the emerging market index, which is down 25%, but we have what we call a group of emerging market unit trusts, which again may focus on more riskier segments of the emerging markets. Those are down 33%, and we have the typical type, which is down this time around almost the same as the index at 25%. So by and large, all major regions were down easily 20, 25, 30, almost 30%. The STI, the local index, was not spared. ICI index itself is down 29. There's one particular fund which is down 33. I believe it's a REITs fund, and the others are roughly about 28%. So more or less near the index. Okay, so basically, the whole month itself, from an equity perspective, there was really very little place to run. Almost everywhere you go to, the declines were in double digits, in the 20s, high 20s. What about the bond market, which is almost always seen as a place to go to? One thing people make the mistake of is they think as long as it's a bond, it's safe. But what we must remember is the bond market is not homogeneous. It means it's not the same across. It's actually of different types of bonds. There are bonds which are more risky and there are bonds which are less riskier. So for example, this table itself would actually show you a good example of the risky bonds versus the safer bonds. So in the bond world, and again I've just taken these are all representing, these are all unit trusts which I've taken, but they are mandated into different types of bonds. Okay, it could be, for example, US high yield bonds, which are considered to be quite risky because it's high yield. Means to say, once you have a high yield bond, means it's a low grade junk status bond or junk rated bonds. So basically, very high returns but high risk. So in an environment where the markets are coming down, it actually has a lot of characteristics quite similar to that of equities, and therefore it fell double digit. Global emerging market bonds, similarly high risk, high returns, and likewise in a down market, the risk is very high. What we can see gradually as we move up the scale, the rating scale or the credit scale, here we have global investment grade. So when we talk about global investment grade, we're talking about companies which are BBB and above. Yeah, so double B is non-investment grade, triple B is investment grade. So you have triple B, you start with the triple B minus, triple B neutral, triple B plus, then you go to the single A, and then double A, and then triple A. So all these are investment grade. So you can see that the losses are less, because again, if you think that a company is of a better quality, then of course the sell-off isn't as great as a company which, for example, in the high yield, which is a junk status. Okay, and this is evident again when we go even higher, which is the Sing investment grade. So these are Singapore, and Singapore is the only country in Asia which has the AAA badge. So again, being a AAA country, the companies also have very high investment grade ratings of AAA, AA and such. So it wasn't a surprise that the high grades managed to shield most of the bonds from the volatility, and in fact the bonds actually made 2.1% over the past 1 month, despite what happened to some of its peers down here, and of course the equity markets. The global short duration bonds did well also. Short duration again is one place where you run to. When we talk about short duration, long duration, is basically talk about the yield curve. When you say short duration, means the front end of the curve, and the front end of the curve you normally find things like money markets, short duration bonds which only have less than a year before maturity. So these are considered to be more or less quite safe instruments, because they are not tied down for long-term 20-30 years. Those are very sensitive to interest rates. Those have more risk because it's held over a long period of time, and so on. Yeah. So again, here it's demonstrated that the short duration, the front end of the curve, was quite safe, and managed to yield about 3%. This is US money market. US money market actually gave 4%. So for bonds, you must understand that bonds, the price of a bond is derived from a few things. One is of course the movement of interest rates. Two is the yield that it provides. So from the perspective of the US money market, you'll find that basically interest rates are low and was cut. You'll find that actually the yields are, even before a cut, the yields were basically very low, 1% and such. So where did the 4% come from? Well, this is actually from the third element that contributes to a bond price, which is the exchange rate or the forex side of it. So the US dollar actually went up quite significantly over the past 1 month, and this 4.1 here is therefore a reflection more of the currency gains, not so much of the gains made from both the interest coupons or even the bond price itself, because money markets are all in the front end. The sensitivity to interest rates are not that high. Yeah, so a lot of it has got to do with actually the currency gains. So when we take the whole universe, equities and bonds together over the past 1 month, what are some of the top performers? So I picked up a few here. So again, we spoke about the bond, the Singapore investment grade. We spoke about the global short duration. There is another bond which deals in US AAAs, government bonds in the US. considered to be, or even companies which are considered to be triple A's. So that has yielded a lot, about 4%. Again, this is a lot to do with the currency. US money market also a lot to do with the currency side of it. There's one particular alternative unit trust which actually deals in volatility, or the mandate is actually when markets are volatile, this particular bond, this particular unit trust does well. And of course, volatility spiked through the roof over the past 1 month, so it wasn't a surprise that this fund itself actually produced quite a very high return of 28%. And we'll talk about that a little bit more later. So this was the best performance over the past 1 month. So in essence, there could have still been a place for long-term investors, for investors who wanted to shield themselves away from the volatility instead of just selling at any price and getting out. They could have just switched into a group of safer unit trusts, and some of these are quite traditional safe havens, things like the Singapore investment grade, things like the global short duration. These are more traditional in a sense, because the rest, or the US money market and US AAA, this would do well basically in the time where US dollar is strengthening, and this happened to be a certain period, particular period. What about the bottom performers? We saw a lot of bad performance just now, and so of course the whole equity markets really did very badly. The question is which one did more badly than the others. Apologies, this is a typo here, but Latin America dropped almost half, by 54%. World energy most likely dragged down by oil prices, dropped also about 54%. Within Latin America, we can see that huge chunk is also from Brazil, which dropped about 51%. US small caps got walloped 46%, and world financials were also down significantly at about 45%. Again, various world financial banks, I think insurance companies, all very sensitive to a slowdown in the economy, and lower interest rates, negative interest rates, and things like that, and the consumer not spending, so on. So a strong barometer of global growth, and therefore it got hammered quite significantly. Let's take a look at some selected unit trusts. Last year, I wrote about four unit trusts which seem to demonstrate characteristics which were slightly more opposite than the markets, i.e. they would be good to hold in a bear market, so to say. Do look at the video, some videos before this. I can't remember whether it's episode 3 or episode 4 or even 5, where I did do a review of these unit trusts in those episodes. And what we find is there's one particular unit trust which I call an alternative cum equities. It deals in global equities. However, the mandate of this unit trust allows it to take a hedging position to protect the downside. So when it correctly makes that call, for example, this time around, the fund managers saw the risk, quickly put on hedges to hedge against the risk, and therefore protected the fund from falling a lot. And the fund only fell 0.5%, 0.5% basically over this really bad period, although its mandate is to invest in global unit trust. Gold miners didn't do well during this past 1 month. I have a video on that, I think the last episode 5 or 2 episodes before, which explains in detail why gold miners and gold itself hasn't been doing well. But we are still bullish on gold, and I think gold has rebounded quite recently, so we're quite optimistic about that. So do have a look at that video. I think that video will explain this 31%. I did mention earlier about this fund, the volatility fund. When volatility spikes, this fund actually does well. So it's a good fund to plug in to your portfolio when there is turmoil, because as risk increases, volatility increases, this fund helps to offset some of those losses. And the short duration funds, the short duration, the short term bonds, yes, sometimes you see a little bit of decline. That's not something which is not familiar with, or at least not a surprise, but it really holds around zero, maybe slightly lower, but that shouldn't be an issue when you look around when the whole market is tumbling. There will be some people who are scared, they'll pull out their funds, therefore putting some pressure even on the short end, but it's not going to decline a lot. Yeah, and it makes up that losses very fast over the next couple of months. So we're quite comfortable with that. So this is just to demonstrate to you that despite the market volatility, there are still places you can go to rather than pull out totally from the market. So again, if you are a short-term investor, it's okay to go in and out because you're short-term. That's what you intend to do, which is to move in, make some money, and to move out, and so on and so forth. But if you're a long-term investor, basically you don't try and time the market like a short-term investor. You don't move in, move out whenever you see risk. You move out whenever you see opportunities, because then you're not a long-term investor, you're a short-term investor. Long-term investors, basically what they do is they try and ride through the cycles, whether the market is going up and down. What they do is basically they try and adjust their portfolios to lower the volatility whenever there's risk, and to increase the risk or increase the volatility whenever there's opportunity. So you can actually move your portfolio, shift your portfolio, not totally 100%, but in a way meaningfully enough to try and take advantage of opportunities or to guard against risk. Yeah, that's really a long-term investor. Yeah, so these are some unit trusts which a long-term investor can use in order to lower the risk of their portfolios in the current volatile environment. Okay, today's a short one. I hope this has helped you to understand a little bit more about where you can actually run to, or rather put some of these things into your portfolio to lower down the volatility. If you think it's helped you, then please do like our YouTube channel so that you can receive more of such episodes in the future. Again, thank you and take care.